Hello, everybody. This material is dated December the 16th, 2024. And my title today is A Zacks Forward Look to 2025, largely on the U.S. economy. That will be my forward look to a U.S. economy. And of course, the financial market will reflect some of the underlying macro fundamentals. So I called this the U.S. economy's four-year cycle because I consider the recession low in 2020, early 2020, the 2-month low of that recession, as now in its four-year cycle, and that 2025 will extend that cycle for another year. That's my base case. I'm not looking further than 2025 in this material. Keep that in mind. So I have three cases to my expansion continuing for another year thesis. Part one, the immigration that has come into the country. This is going to continue to raise incomes. It is going to provide a little bit less of a federal fiscal deficit, and it will keep inflation under control for at least the next year. Part two, we will get into the U.S. economy at a glance material from the Federal Reserve of St. Louis. It used to be called the Fed Macro Snapshot. Now it's called the U.S. economy at a glance, and they have 8 slides for you to review. And you can go to this website and continue to update yourself. And I recommend you do for the next year. Part three, we'll get into U.S. financial conditions, and I will show you material elements within the financial market that are telling me that this expansion will continue. So, of course, this is my views. I do have a PhD in economics from MIT. They are not necessarily the views of Zacks Investment Research. Keep that in mind. I'm speaking clearly here as a professional economist, not for the company. All right, well, number one, I'm doing this just in advance of the December economic projections. So I'm using September projections, but I want to lay out the Federal Reserve's thesis as it changed between June and into September for unemployment, for the core consumer inflation rate, and the core Fed funds rate. So, of course, we all know the June projection had a higher Fed funds rate than the September projection. And we're looking at getting ourselves to 4.4% this year, which is basically there now. And that we're going to get to 3.4% next year. So 100 basis points next year. And then in 2026, another 50 basis points. So 100 to 50. So they got 150 basis points or 6 cuts from here. They're going to make 4 next year and 2 the year following. That's the base case in September. We'll see what happens in December. Now, what they're thinking is they're going to get to 2026's Federal Reserve statutory mandate of 2%. They will not get there next year, but they will ease their way there. So rates will fall as the core PC rate falls. And they used to think that we would get down to a rate on this ascent with a little easier play in September versus June. We will see what December says. Now, here is where it gets interesting. The one thing they did raise in the face of lower inflation is higher unemployment from June to September. I need to explain to you how the Federal Reserve System, the Board of Governors, came to think that lower inflation would come with higher unemployment. This is, partly a soft landing, but it's also partly a story of immigration. So I will get into this, and I will share with you some insights that might help you see why I think what I do. All right, so immigrations is a subject. The best place to go on a subject is this, so you stay out of getting yourself caught up into a study that isn't a study, is to go to the Congressional Budget Office, the CBO. Their job is to study things like this for you, for the Congress, for the Senate and the House. And they have, in my experience as an economist, a really strong set of economists. And they really are as nonpartisan as they can be. The material I'm showing you today is from July 2024. And I put the blue hot link at the top for you to review this yourself. And I suggest you do. Certainly take a look at this so you understand how the CBO works and read the entirety of this report because it's very interesting. I just want to point out a couple things. For one, yes, we did have immigration surge after COVID. Of course, this was bottled up because people didn't move around during COVID, and then it surged all the way up. And yes, it's going out. You can see here, at least to 2025 in terms of its effects on the overall growth rate. And you can see here what happens. Of course, consumption rises when you have more people in the economy producing. You're going to get them get incomes and they're going to spend. Non-residential fixed investment will go up, and residential fixed investment will go up because, of course, they will look for housing, which will keep support under the housing market. And yes, there's some extra government spending. However, if you look down here in the deficit, I want to point out that for the next 10 years, they're going to lower the deficit by a grand total of $897 billion because people pay basically taxes on their income. It's basically what happens. You can look through all this. The net effect of taxes, of course, is the biggest, but they also add on changes to the economy. And that's sort of 2/3, 1/3 if you look through this, is how this works. Now, the rest of this you can get into at another point in time. I just want to point out this bolded statement: 8.7 million people greater than it would have been if the annual net immigration was 200,000. So we've added 8.7 million people. Now, the number to look at that in reflection is, let's say, 160 million in the civilian labor force. The people that come in are not all labor force related people. So let's take it to 6 million. You might get, like it shows, 2 to 3% of a bump. Now, why did we do this? Well, part of it was COVID and people bottled up, but part of it was this. This is the civilian labor force overall. And as you can see, thousands of people, non-seasonally adjusted, it fell to 2.5% during COVID. Of course, some people left the labor force, some people died. Some people were had long COVID. Some people stayed home and never went back to work, like I said. So when you get this situation, obviously immigration is the way you replace the missing labor force. And that is not uncommon. Keep this in mind. This was a macro activist use of immigration in a lot of countries. The most notable that I know of is Australia. And you probably don't know this, but they have used immigration to keep their country out of recession for 35 to 45 years. This is data on the immigration percentages, growth rates that they had added to their economy, almost 1 for 1. And you can see right here, for example, 2008 to 2010, when they, of course, there was a financial crisis, they surged immigration from 1 to 2%. But keep this in mind, this is a much smaller 24 million person economy, not the US. Now, they did not surge 8.5 million people here. So, 2% of this 24 million, you can think of it in just a couple 100,000 of people, but it truly kept them out of recession. They did not have a recession in Australia during the financial crisis that happened in the United States. And 28.2% of residents are now born overseas in Australia. United States is down at 14%-ish area, to my recollection on the latest data. I've got the link to Australian GDP growth and the link to the Parliament Australia's study of this. But keep in mind, they peaked it in 2008 at 2.2%. That was activist use of immigration. So, like I said, if you don't want a recession, you can use immigration for the purpose of building growth in your economy. Now, I also got a paper provided to me by the executive advisor to the president of the Inter-American Development Bank, Elon Goldfein. He was a contemporary of mine at MIT in economics. We do know each other. And he was, I was grateful to Amanda to put this up on Twitter, and I found it. And so what it's going to show you is the fraction of people who are wishing, planning, and also preparing to migrate in blue, that it generally rises across the income distribution, a remarkably robust relationship from Africa, Asia, and Latin America. So they looked into, in their job, 99 developing countries, and they found that the wish to plan, prepare, and execute a migration and immigration rises across the income distribution. What that means is, no matter what the country is out there in the world, developing wise, we get the high income, high educated people. Getting an immigration move from one of these countries to now is really getting us these types of people. So to prove that, I'm going to go through first a little bit about the IADB so you understand it. It's an old thing that this deals with kind of the World Bank for Latin America and the Caribbean, and this is the data they picked. As you can see, this is the immigration proclivities in Bangladesh, in Yemen, in Honduras, in El Salvador, in Nigeria, El Senegal. And no matter it's middle income countries or low income countries, the likelihood of somebody wanting or being able to migrate is higher for the higher income people. You can see it's out here where the number is always going. It doesn't matter what country. So I call it, in the Zacks terms, the Schwarzman effect, not Charles Dickens. So what I mean by that is this is not the 19th century. This is Schwarzman. If you know, he's our research director. He's been working for Goldman Sachs. He went to Kellogg School of Management at Northwestern. Super talented manager, and he's also from Pakistan. So he fits this model perfectly. He's from a wealthy family in Pakistan. He has been educated well. It's what he came to the country for, our educational system. So this is the Schwarzman effect. Do not think of this as a Charles Dickens effect across the board. By the way, that will include Venezuela. A lot of people worried about the Venezuelans coming to the country. They're likely the more high-income people in general. Again, as a generalization, there's obviously a lot of poor people too. All right, let's get to the U.S. economy at a glance. This is the Fred system. Like I said, here's the snapshot, used to be called. Now it's the economy at a glance, and this is where you find it. Just click on that link, and it will provide you all these things. And they load these in real time for you. So you don't have to find out if they're new. Whenever there's data out the system, the U.S. federal system, they will supply it and bring it back to you. So I went ahead and pulled all of the latest stuff through Q3. And what I want to show you, like I said, over the last 4 years of this expansion, we got out of it in a bunch of growth. Of course, that was just after COVID. And they released the supply restraints, public health restraints. And then I want to show you basically across the last 4 quarters, if not the last 6 quarters, we've been in steady state growth around 4 to 5% even, really strong growth. This is, by the way, percent change from preceding quarterly period, not necessarily economic growth rates. But I just want to point the overall trend has actually been stable for quite some time and not low at all. There's been no reason to think of a recession over the last 6 quarters. Believe it or not, just look at the data. No reason to believe there was a recession for the last 6 quarters, year and a half, folks. Okay, why? All right, this is just me doing the movement of a positive supply shock or a negative supply shock. And as you can see, I'm just pulling it down and up. And this is what happens in a COVID pandemic. Now, in all of macroeconomics, as most people understand it, it's this movement, which is demand shocks. And as you can see, when I move this around, this is like the leading indicators and all the Keynesian economics. Basically, you're going to get more demand as you rise demand up and more higher prices. But what you can find out here is that if you cut back on a negative supply shock, you'll get higher prices and lower production. And then as you come out of that and raise supplies, you will get lower prices and higher production. It's a very different thing than if you do this. That's higher prices and higher production. Here you get lower prices and lower production. So that is why a lot of people did not get this call right. This was a once-in-a-century event that had nothing to do with this as much as it had to do with this. So keep that in mind. Okay, so here you got consumption. Basically, other than some seasonality adjustments here, this has been very strong for 4 years. So again, from their economy at a glance material, U.S. consumption, real personal consumption, absent the price effects, has been strong. All right, Now, here is the interesting thing about our prices. This is the PC prices for the city average. And this is the other chain type indexes. I just want to show you that no matter what you get to, getting down in the 2.4s and the 2.1s here, which is good news. That is actually consistent with the Federal Reserve wanted, and this is what they do pay attention to. And you can see that really it was last summer that we got out of the COVID pandemic supply shock, and we've been just kind of ambling our way down there now for a year and a half. Like I said, a year and a half came through in the growth rates, and now a year and a half came through it in prices that are only steadily declining as opposed to rapidly declining during the early part of the supply shock. All right, now this is another point. The payrolls all the way out in time, you can see that we basically have been coming down. This gets into this hurricane thing. This popped back up to 240,000 now. But you can see if I draw this line around 200,000, we've been in there for almost 2 years. So absent hurricane events, we've had really solid growth in employment for the last 2+ years. Before that, of course, that was us working at the supply shock, but also bringing jobs back online. Okay, so here's where I draw this line was when the highs came in for inflation. That was sort of March, April of 2022. And here is, basically this period when we got to this period. So there's basically been this supply shock COVID period, the inflation peak, the decline to this moment where we started going sideways and then down through this period. So this time inflation fell and job additions fell over time. That is consistent with the supply shock narrative that I showed up for you. Prices can fall and people can still add jobs at a slower rate. So growth continues, but it gets lower and lower as inflation falls. And the fall in inflation is commensurately less as the growth is less and the jobs are less. It all comes together consistent with the resolving of a supply shock. Okay, so here is what you can see here. Now, I want to just point out how different a COVID supply shock looks to these other cycles. Yeah, these were smooth declines like this. Here you've got a totally different situation. You cut things down from COVID and then you built it back up to trend. So this somehow got related to these, like we're going to roll over, and this never happened. Of course, it wasn't going to happen. This was just the economy going back to this trend. And so now that the prices, have slowed down, the Fed is starting to cut rates, and that's really quite different than this and quite different than that. And you can see this yourself. Here is the all employee numbers, like the total number of people working. Now we're getting up to that 160 million that I told you. We're at 159. We were at 152 before COVID, 152 to 159. Lo and behold, that is 7 million. How many immigrants did we have? 8.5 million. So we filled up a lot of those jobs by getting people in the country to do those jobs because people didn't want to do those jobs. Retirements, death, disability, or just staying home. Okay, unemployment rate. Now it has been slowly rising again from last summer. Remember, again, last summer was when we started the entry to slower inflation, and that did create more employment over time because we basically don't have the growth to soak up on many jobs. But we're still really in a good place overall. This is, a U6 number, not the U3 number, a little bit higher because it includes part-time jobs. But again, you can see we're actually coming back down to this area and have been here for an entire year, pretty low. So housing starts. Now, do we have a housing crisis? Well, again, you're looking at a pretty good number in thousands of units, stable for the last year and a half. That is actually a fairly good story here. Of course, there was more of an issue. People weren't constructing during the early part of the pandemic. They got going later, and that has carried on as construction has been strong. All right, fixed residential private investment. That's going to be this orange line. The blue investment, residential investment, and then, private, non-residential is orange, private investment, and then private residential is blue. So I just want to point out here the '08 crisis. This is private residential fixed investment. No, there was not a black swan event. You had private residential fixed investment dying and going negative for 2 years before the recession. That did not appear to be the case in 2018 or 19. Certainly getting quieter for a while, but it was nowhere near like this collapse. And of course, here, a totally different story of what the pandemic was. There was the Federal Reserve interest rate, zero rate. It came back down, during the early part of the resolving the supply shock, and now we're back up, not down in terms of residential fixed investment. So this is going down, 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 down in front of the recession. This is going up, up, up now. Totally different story. Keep that in mind. All right, well, I'm going to finish up this whole talk with financial conditions in the United States. 10-year Treasury. Again, largely going sideways with a lot of noise. We've already been up to 5. We've already been up to 4.5. Now we're at 3.8. This is a little bit old. I think I get a 4.2 number here. 40 basis points is not going to change the story here. Like I said, you're just going to toggle around here over this period of time. Here's the real interest rate. So I just want to point out the Federal Reserve generally likes a 1% rate. That's down here over the last 10 years. They're at a 2% rate. So you can get to 1%. That's 100 basis point rate cuts. That's what they're going to try to do next year. And then the other 50 basis points will become from moving the core PCE rate from 2.6 to 2.0. That's basically 50 basis points. So there's two parts of what's going to happen here. First, the 100 basis points take the real rate down to 1%, and the other 50 basis points when they resolve the remaining piece of inflation. That's basically what's going on here. Now, the other thing I want to point out here that's kind of lost on a lot of people, for we're not economists, is the March regional banking crisis. Since that time, which is now 18, 19 months ago, we have had very loose financial conditions, only tightening lately, very, very modestly in this last period. So what does this mean? It means that, this is the Fed's economy glance stuff. This is actually the St. Louis Fed Financial Stress Index is the real measure of how much stimulation is coming from the financial system. And as you can see, it's actually been quite strong for 18 months. So if you're a stock investor, this is what you should have been paying attention to. The St. Louis Fed Financial Stress Index has been low versus this period where it was high and volatile. So there was a lot of worry about the inflation, and then the inflation debated. And actually, the Fed did the regional banking crisis, which had the effect of creating a bull market because the financial stress dropped because of all the things the Fed did, not just the policy rate. All right, here is an example of that policy rate and the money market funds. They've been building, obviously, up with the Fed policy rate. So people have been parking CD money on the Fed funds rate, and they're probably going to do the opposite on the way out, but not immediately. There's still a 4.5% CD rate out there in this environment. But keep in mind, money market funds, there's a ton of them. I mean, I'm talking, we're talking trillions here, of money in the money market funds as a result of the Fed fund rate hiking. That is another bull market effect. All right, so as JP Morgan put out in the fall of 2024, in the fast 40 years, when the Fed cut rates, they did it 12 times. When the S&P 500 was within 1% of a record high, and the market was higher a year later, all 12 times with an average return of 15%. So this is what happened here, and that is the return you should expect in 2025. That will add to discretionary income, that will add to discretionary consumption, and that will add to personal wealth in the United States for 2025. Like I said, I am not bearish on 2025. 2026, different story. Bankers work on presidential election years, generally a point stronger than non-presidential election years. So we do have the headwind of 2024 of having been an election year and having seen somewhat stronger returns that did and was consistent with 2024. There is a strong wealth effect coming from the stock market from 2024 into 2025 already. Now, they also got into the volatility and the voting presidential elections. And the basic point here, as you can see, all these are elections. This is the global financial crisis, the dot-com crisis. Those were big financial market shocks. These are election results. Intraday volatility generally doesn't move around with elections, and it did this time as well. All right, equity market volatility tracker. I just want to point out we are going back up in the volatility tracker that's concerning elections and political governance. I think this should resolve itself in the first part of the year, but we do need to note that this is going up because we don't know exactly what the new administration will do, and that's what that's reflecting. All right, leading indicators have bottomed. Not that they're at a bottom, but they have bottomed, and they're coming up. And that typically signals the end of a recession and stronger growth ahead. The Fed's rate cut will likely put fuel on this fire. So it's not so much that we have negative leading indicators, it's that we have the bottoming and coming up. And as you can see in this picture, when they come up, 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 we have periods of growth. So this was just a supply shock situation. Some of the weakness that came out of over delivering and then under delivering in the manufacturing groups. And now we're coming back from that as well. So that's also positive on 2025. The bottom is in on the leading indicators. So why no recession this time? One thing I want to point out, the federal government policy made the economy better this time. This is, keep this in mind. For example, we have a lot of propaganda during elections. We have the Russian situation creating propaganda, the Chinese situation creating propaganda. There's been a lot of people out there trying to convince you otherwise of what I told you today. Number one, the federal government did a good job managing the U.S. economy. Number two, there has been no recession in the data, period, for the last year and a half. So what's the lesson here? Stay out of rabbit holes. A rabbit hole is something that people get into a lot when they start thinking they have some scrolling on the internet, and they find their way to a negative story, and they go down to a negative other level of scrolling to another negative story. People do this a lot. There's a lot of Reddit holes out there to get into. You get in the Reddit channel, a lot of people screaming about negative economics data. There's always some adjustment going on out there. So this is an example of what Merriam-Webster wrote about what a rabbit hole is. While trying to find the picture again on Google, I fell down the Cosmo rabbit hole, which is the magazine. So scrolling through a gallery with swimwear, I again came to the how to be sexier instantly, and then through all 23 slides of sexy ideas for long hair. So you start out in one place on Cosmo, you go all the way down to sexy ideas for long hair. That's an example of a rabbit hole. You just went down, 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 down like a rabbit in a hole. And that can happen with economic data. It often does go on with economic data. So that's it for me. I hope you enjoyed this. This is a version of this material. And you can certainly find this from us at Zacks Professional Services website. And with getting these slides, you just need to give us a call at Zacks Professional Services. That's it for me. Thanks all.